All right, let's get right into it. Today, we're diving deep into an explainer of the highly anticipated Q1 2026 financial results for India's largest IT services company, Tata Consultancy Services, or, TCS. And we've got a lot of fascinating data to unpack today. Look, if you've been following the tech sector lately, you can probably feel the anxiety hanging in the air, right? Everyone is constantly wondering how artificial intelligence is going to reshape the landscape, and maybe more importantly, what it means for the actual people building these systems. Well, the numbers from TCS's first quarter are officially in, and they tell a story that might just completely flip the current narrative on its head. So let's address the elephant in the room right off the bat. K. Krithivasan, the CEO and managing director of TCS, stated this flat out. Don't believe AI will reduce overall headcount. I mean, in an industry that is currently obsessing over efficiency and automation, that is a massive, bold declaration. Okay, here's our roadmap for today to see how the numbers actually prove his point. We're going to tackle the AI job myth, break down the Q1 finances, compare margins against headcount trends, explore the AI revenue strategy, and then wrap up with the future outlook and headwinds. Let's jump in.
Section 1. The AI job myth.
Now, there is a very widespread fear that AI is basically coming for all the tech sector jobs. But management is firmly rejecting the idea of an AI-induced contraction. Krithivasan noted that they simply don't see a massive deflation happening because of AI. Actually, it's kind of the opposite. Any efficiencies they gain are entirely compensated by a massive surge in new, complex opportunities. So it's really not about doing less work. It's about doing, different, higher value work. And honestly, just look at the proof behind that claim. In Q1 alone, TCS added 9,279 employees on a net basis. They also successfully onboarded 14,000 campus graduates. All the while, their voluntary attrition rate actually dropped down to 13.6% over the last 12 months. This brings their total global workforce to an absolutely staggering 593,798 associates as of June 30th, 2026. I mean, think about that, almost 600,000 people. That is practically the population of a major city, and the chief HR officer made it crystal clear. They're out there actively scouring top universities across the country specifically for digital and AI native talent. They are staffing up, not scaling down. Section 2. Q1 financial breakdown. So how exactly are they funding this robust headcount growth? Well, TCS pulled in over $7.62 billion in revenue this quarter. And despite the ongoing geopolitical uncertainties and those inflationary pressures that usually choke up discretionary spending, they showed some serious resilience here. Plus, they backed up that revenue with a massive total order book of $9.5 billion for the quarter. Now, yeah, that is slightly down from the colossal $12 billion we saw in the previous quarter, though, to be fair, that was admittedly inflated by a few rare mega deals, but it's actually up from the $9.4 billion reported in the same quarter last year. So the deal momentum is for sure still flowing. Let's break down these supporting figures to really get a read on the health of the business. Consolidated net profit came in at a very solid 13,349 crore rupees, which is a 4.6% increase year over year. But the big takeaway here is the incredible bounce back in the India market. It jumped 22.9% year over year, recovering beautifully after that massive BSNL deal culminated. Oh, and a quick note for the shareholders tuning in, the board did approve an interim dividend of 12 rupees per share.
Section 3. Margins and headcount trends.
Okay, now we hit the financial tension of paying for that massive, growing workforce. TCS rolled out global annual wage hikes on April 1st, mainly to align with the new India labor code. And as CFO Samir Seksaria pointed out, these wage hikes dented profits by 170 basis points. That's 1.7%. That pressure dragged their current operating margin, or EBIT, down to 24%, which was slightly below some analyst expectations. But, and this is key, management remains highly confident. They are targeting a 25% plus exit margin sooner rather than later. And you can see exactly why margins compressed here. The sheer cost of this human capital investment is staggering. Employee benefit expenses rose sharply this quarter, jumping from just over 40,000 crore rupees to over 42,137 crore rupees. They aren't just absorbing routine raises, right? They are investing heavily in future-ready AI infrastructure and the specialized talent you actually need to operate it.
Section 4. The AI revenue strategy.
So, what is the plan to make a return on that massive investment? Well, TCS announced a real standout number, an annualized AI revenue run rate of $2.6 billion for Q1. That is up 13.6% quarter over quarter. They're not just throwing the word AI around in press releases, they are actively, aggressively billing for it at an incredible scale. But there's a really fascinating detail the CEO noted here, something that kind of changes how we view this revenue stream. He explained that right now, AI revenue doesn't have much annuity or recurring revenue built into it yet. The market is just moving so incredibly fast that TCS basically has to constantly go out, hunt, and win these AI deals in a super tight time frame of just 1 to 2 quarters. It's a high-velocity game of constant client acquisition. And the thing is, they're winning those high-velocity deals. They secured a marquee $800 million AI-led transformation deal with Swedish manufacturer SKF. That's actually their 6th mega deal in just 5 quarters. Add to that, they became the first global system integrator partner for Mistral AI, they locked in a strategic partnership with Anthropic, and they even got impaneled by the Indian government to deploy AI across central and state departments. They are building a massive, diverse AI ecosystem. But obviously, executing a $2.6 billion AI strategy takes immense manpower. And this brings us back to a massive internal transformation. In just Q1 alone, TCS employees completed a mind-boggling 14.6 million learning hours, acquiring 1.3 million new competencies. Because of that push, over 312,000 associates are now highly proficient in AI and machine learning. Remember earlier when Krithivasan said people will be doing different things? Well, this real-time workforce evolution is exactly what he means. Section 5. Future Outlook and Headwinds. So we've seen the impressive Q1 performance, but management did map out a somewhat cautious timeline for the road ahead. The CEO acknowledged that Q1 was absolutely driven by inflationary pressure and geopolitical tensions that impacted discretionary spending. Looking forward, though, the banking, financial services, and insurance sector is looking solid right now. Tech services will continue to grow, and they actually expect a turnaround in life sciences and manufacturing in Q2. The only real holdout is the consumer sector, which management says kind of needs the global geopolitical dust to settle before it fully recovers. Now, to navigate these headwinds and convince cautious clients to actually open their wallets, COO Arthi Subramanian highlighted a major strategic shift. TCS is defining their entire operational model around what they call forward deployed engineers, or FDEs. See, clients are super hesitant to spend without guaranteed returns. So TCS is focusing heavily on outcome-based deals, taking these complex product capabilities and directly translating them into measurable enterprise value. Which brings us to the final piece of the puzzle. I want to leave you with this provocative thought to ponder. We've just completely debunked the myth that AI means the end of IT hiring. I mean, TCS is literally out there proving that AI drives a $2.6 billion run rate while requiring more highly skilled humans, not fewer. So as they continue to invest heavily in their workforce, how will the eventual return of geopolitical clarity shape their aggressive push to reclaim those 25% plus margins next quarter? It's a fascinating balancing act between human capital, cutting-edge AI, and global economics. Keep this paradox in mind as we look forward to their next earnings print. Thanks for learning with me today, and I'll catch you in the next explainer.